Today, we're going into a property of the week that has no waiting list or construction delays and a 1.2K buyer credit at closing. We're officially sharing live on Facebook for the Thursday edition of the Not Your Average Investor Show. Today, we do the JWB Rental Income Property of the Week. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately call GC because he generates cash flows, because he's got some genius concepts, because he's a great co-host, and because his name is Gregg Cohen.
Your eyes when you start going down this path.
It's the eyebrows.
It is intense. It is great to be here with you all. I wish you all could be in the studio to feel the momentum once we're here, the positivity. I mean, we're ready to rock and roll. I hope you guys are ready for today.
Man, I am so ready for today. And I hope you are ready to find out about rental income property investing, because you're in the right place. To find about best-in-class property management services for rental property investors, you're in the right place. And to find that edge in the Jacksonville market, the hottest market in the world.
I love it.
I mean, it's definitely warmer than other markets for sure.
Is it hotter here than in the metaverse?
I don't even know what the temperature of the metaverse is. What's that measured in?
I don't know.
Me neither. BTUs? I don't even know. All right, you're in the right place. If you want a personal plan, if you want some personalized advice, go to chatwithjwb.com after this call, set up a time, talk to one of our experts, value add conversation for anything that is on your mind. And right now, Greg, it is time for my favorite, the roll call. You ready, buddy?
Game on.
Roll call. John Henning is chiming in first. Good afternoon, all. Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
Good afternoon, Marilyn. Lee Bishop, the MVP of the Not Your Average Investor Show community, is in the house. Hello, gentlemen. Joanna, our community manager, who's hanging out in the chat. She's going to get you anything you need. If you got questions specific to a past episode, specific to a website, anything like that, let her know in the chat. She's here to help. Thank you, Joanna. Leo is in the house from the West Coast. He says, good morning. Man, good to hear you guys again. I feel like it's been a while. It has been a while, Leo. We missed you, buddy.
Yeah, we have.
Yeah, man. Ken Moline, the patriarch of the first family of the Not Your Average Investor Show. Rosalind Riley.
Returning guest, Rosalind Riley. Thank you again for helping me remember.
Returning Rosalind is back. Good morning from Marietta, California. Chris Gonzaga from the Hudson Valley. He's back. Welcome, Chris. Steve Lax's backs. Hi, everybody. Steve, we were just talking about how you're going to be Lax's backs from now on. Good to have you back, Steve. Peter James from the esteemed Commonwealth of Virginia. He says, you guys rock, both have the swag. You know, Greg knows that my love language is swag.
Yeah, I do. I know what makes you tick.
He knows what makes me tick. That is a sign of a great co-host. That's why they call him GC. Anthony Ditta's in the house from Jupiter. Good to have you back, Anthony. And Michael Santorios. Good afternoon, everyone from Northern Virginia. Raj Bantu's back in the house. And before we get started, we got breaking news.
This is extra breaking.
Extra breaking. It's breaking hard.
Yeah.
We have our meetup dates set. Los Altos, California, February 5th. Seattle, Washington, March 29th. Denver, Colorado, April 3rd. Pittsburgh, Pennsylvania. Woohoo! May 29th. And we will be coming up with more details in the Facebook group. We'll be emailing you. Let us know. Reach out to us in the Facebook group, or reach out on Facebook, or shoot us an email. All the information's inside the podcast description or the YouTube description to reach out to us if you want to be a part of these. These are our IRL meetups. It means in real life. We have members of our community with the fairy godmother, Jen Filson, leading the charge, that are putting together these meetups so that you can meet other not your average investors like yourself, chat about rental property investing or whatever else you want to invest in, and, you know, build some real bonds and learn from each other. That's why this whole thing started, is to build a community. And I love that it's gone IRL.
It's incredible. It's just a fun growth moment for everybody here on the show who's been watching, being a part of this for the last 2 years. You know, to know that this is organically grown from you all. You all have been asking for it, and now we are all doing it together. So if you want to take this thing, maybe you're listening to this on a podcast, or maybe you're tuning in here on Zoom, but you maybe you don't ask questions, you haven't quite interacted yet, and you want to get to meet real life people that are actually investing in rental property. IRL people. This is your opportunity. And we're just so thankful for Jen spearheading this, and for all of our community for opening up their their homes sometimes to invite folks to
Sure.
come in, like Ken Moline, who will be opening up his home, I believe, on the February 5th
That's right.
event. So take advantage of this.
Lee Bishop spearheading Pittsburgh, even though he lives in Baltimore.
There we
Lee
go.
is lifting big on Pittsburgh. That's why he's the MVP of the non-traffic industrial community.
You know,
IRL meetups coming up, and we also have another. We got another breaking news. GC, what do you got?
yeah. So I was sitting in our Tuesday morning meeting here at JWB, and I'm always just trying to glean really cool nuggets or information that I think can help you all. For you, if you're a current client, this is really cool information because it's benefiting you. And it might be some things that you might not be thinking about when you're making your decision of who to invest with or where to invest or what to pay attention to as an owner of rental properties. So here's something that you might not be thinking of. In 2021, JWB saved our clients over $106,000 by solving maintenance items over the phone instead of just taking a work order and sending a vendor out to solve that problem. Everybody on my team understands at the end of the day, if we can drop maintenance and vacancy costs, the end investor wins. And when the end investor wins, everybody wins, right? So yeah, over $106,000 has been saved by our property management team. 11.3% of all work orders coming into the office get solved over the phone. And when that happens, that means zero cost to you as the owner and a much better experience for the resident because it's solved immediately rather than having to wait and coordinate to get a vendor into the property. And if you run the numbers there, so there's 1,157 work orders solved over the phone over the course of the year. And that's 11%. So that means there's over 10,000 work orders that come into JWB that our wonderful team handles professionally to make sure that those get solved. And when you're taking care of 11% of them and with a $0 cost, you're doing some great things for owners. And a little bit more information here, 38% of those work orders that were solved over the phone are some of the highest ticket items, right? Yeah. So HVAC was the highest percentage of the ones that were solved over the phone, right? HVAC, many times people would just kind of, property management companies would accept that there was an issue and just call a vendor out. Well, we saved $31,000 in just trip fees by solving those problems for ACs, which are routine, general problems that can be solved, tripping the breaker or, using the shop vac to clean the lines or something like that. So just this extra effort goes a long way to reduce your maintenance costs. And again, as you're a rental property investor owner, your maintenance and your vacancy costs are going to be your biggest pain points. So make sure you're working with a property management company that cares about the little details. They can add up to over $106,000 saved.
That's interesting, man. So as you were going through it, I was going to ask you for some examples, but you did, right? It's like the whole troubleshooting it on the phone with somebody as opposed to just thinking, do other property management companies, are they just like, oh, okay, let me just get the AC guy out there because they make a cut on, is that profitability,
Yes.
profit centers for other property management companies that aren't vertically integrated?
You bring up a really good point, right? So most property management companies don't hold themselves to the standard of producing a return on investment for you, right? They hold themselves to the standard of keeping somebody in your home, right? Well, there's a lot of ways to keep people in your homes and not deliver a return on investment, right? Property management companies don't think in terms of return on investment. Also, if you look at how property management companies make money, they generally make a 10 to 15% markup on routine maintenance for you. How much does JWB charge for a markup for routine maintenance, Pablo? 0, right? Why do we do that, Pablo?
Because you are incentivized to provide a long-term experience because you are vertically integrated. You don't make your money there. You're making money by building your portfolio, and you only do that by incentivizing long-term behavior.
Yeah, we make money when you all buy houses from us. That's the biggest income stream. A property management company, their biggest income stream are fees. One of them is maintenance markups. So yeah, so if a resident calls into a normal property management company, if they solve it over the phone, I'm sure they try to do it, but if they solve it over the phone, they're actually reducing the income they would earn. Because if they just charged a trip fee and sent somebody over, they would earn 10 to 15% on top of that. So you bring up a really good point that I wasn't even thinking of.
All right. I'm glad I did that. And now we're going to magically whisk ourselves away to 7532 Canaveral Road, Jacksonville, Florida, 32210. It is a beautiful renovated home here that has this kind of 1950s lines. I like these homes that you see around Jacksonville. Just FYI, if anybody cares. Purchase price of $205,000, 5-bedroom, 2-bathroom with a carport. Lease for about $1,275 per month for 2 or 3 years. And what JWB here sells actually, right? This ROI, this total monthly cash flow with conventional financing of $131, and this total ROI of 8.16%. If you are following along at home or you are listening on the podcast, go to jwbinventory.com. You can download the sheet. GC, what do you like about this house?
Gosh, I thought you'd never ask, man.
I'm remembering these times.
Yeah. Well, the thing that I love the most about this house is what I love about any property right now. And it's because of the interest rate environment we are in, where interest rates are on the rise. This has been signaled by the Fed. If you've been watching the show, you're probably getting tired of me talking about it because it is that important. And we've been talking about it that much, especially over the last probably 6 to 8 weeks. The Fed is reducing its purchases of bonds and mortgage-backed securities. And for all that fancy mumbo jumbo talk, whatever that means, what that means is it's going to have a direct effect of increasing mortgage rates. It's going to have a direct effect of increasing the rate of long-term debt. In addition to that, the Fed has also said they are going to raise short-term interest rates 3 times, maybe even 4 times in 2022. That will also have an indirect effect of raising long-term mortgage interest rates. And what I just read, which is even new news to me, I just read it a few days ago, is the Fed is also considering reducing their positions of their mortgage-backed securities and starting to sell some of those positions off. So we've talked about, instead of buying $120 billion a month of these positions and bonds and mortgage-backed securities to go, that's going to increase rates. And then, of course, if they go the extra step of starting to sell some of their positions, that's going to increase the supply and actually increase rates even more later on. So, there's a lot to be said there, right? The general gist here is that there's great interest rate risk right now for properties that can't close quickly. So what I'm going to put in front of you for the property of the week is something that can close quickly, because that is where I think your best return on investment is right now. We're lucky to have renovated homes. Generally, renovated homes can close more quickly than new construction homes, because a new construction home generally takes 4 to 6 months to actually close on it after you put under contract. So that's why I love Canaveral. This thing can close, and we have other properties in our inventory right now that clients can put under contract today, lock in this interest rate today, which is lower in my estimation than what it's going to be in 6 months from now, in a year from now. And I put some numbers to this because I want people to get it beyond maybe just understanding that interest rates are going up. A 1% increase in interest rates equates to a 33% decrease in return on investment for this property, for any property, right?
1% increase in interest rate is a 30% decrease for properties.
30% decrease in return on investment.
In ROI.
And ROI, right? Like it'll go from like an 8% return on investment, like this property here on Canaveral, down to like a 5.5% return on investment.
Wow.
Just because interest rates go up from 4% to 5%. So that's why I'm coming so strong. That's why this is the deal of the week. It's because the deal is the debt. The deal's always been the debt. And the deal is not going to be as great as far as the debt 6 months from now, a year from now, as it is today.
Every week that we're discussing this stuff and you're bringing up these properties, my blood pressure goes up and up. And the idea that, and I'm just speaking personally, right? But like I keep flirting around this idea of like cashing out some of my 401k and locking in some of these returns, right? Am I wrong in thinking that, and I know you're never going to tell me to not diversify, right? Like I understand this, right? But if I see my 401k as something that if I can get like 10 to 12% from, I'm crushing my 401k. And right now, if I were to take this ROI along with long-term appreciation, and I'm going to be in it for a full market cycle, and I'm able to take $100,000 out of my 401k and still keep some in the market, even though I'm going to take a hit on that 401k to take that cash out, right? Whatever that may be, 40% or 50% or whatever it is. So I'm really only taking out 50, but with that 50, I can lock in, these like returns that we expect of like 24%. Am I crazy of thinking that, man? Like, cause that's where my head is at, right? Like, do I take a loan out? Do I cash it out?
Yeah.
I these numbers make a lot of sense to me, what you're saying to me. And I take your advice seriously.
Yeah. Well, all right. So let's talk about a couple of things. So you have a 401k and you're thinking about possibly taking an early withdrawal, which would include a penalty.
Yes.
Right. So it's in addition to paying the taxes, there's a 10% penalty for an early withdrawal. Right. Were you thinking maybe 40 or 50%? Or where
of what the overall taxes plus penalty would
Yeah.
probably be like a hit of like 30 or 50% is what in my head.
It really wouldn't be a 30 to 50% hit. It'd be a 10% penalty. Plus you're paying the taxes, which in essence, right, paying taxes today is worse than paying taxes later, right? It's hard to equate like what that real, that real cost is, because there's a lot of factors that would go into that. But it's a 10% real cost plus the cost of you paying taxes today at your tax rate versus what you would pay it later, which is not like, it's not like an extra 30 or 40% hit. Right?
Okay.
It's a lot less than that.
Okay.
But regardless, like if we can come up with a strategy where you don't have to take that 10% hit and where you don't have to pay the taxes today and still be able to build your portfolio, that would be ideal. That's where I would start first. What you asked is like, am I crazy for thinking this? We could absolutely justify what you're saying, doing, taking money out of your 401k and taking a withdrawal. We could justify that with a return on investment calculation. You could.
Okay.
Does that mean it's right for everybody? No. Right? Could you? Yes. It would be the way that I would like, that would be the last option for me. Okay. Right? Just truthfully, right? Like I would rather you not take a 10% haircut in your 401k. Part of this is because usually you can come up with other ways to find the money. The first opportunity for me would be taking a loan against your 401k.
Yeah, that's what David Blattner is saying in the chat, that you can take a loan and pay yourself back in over like 5 years.
Yeah, so that might be the first thing to look at, right? And many people aren't aware that you can actually take a loan against your 401k, but I do it. It is very common to be able to take a loan against your 401k. And what happens is, and for our product here at JWB with our 401k, you can borrow up to 50% of the value of the 401k. And literally, if you have $100,000 in your 401k, that's like you taking $50,000 out of your 401k and giving it to yourself personally, at which point you could use that $50,000 to then put as down payment on a rental property and get great long-term rates.
Seems like a no-brainer to me.
I think that's a really good option for you based on what you want to do.
What are like interest rates and stuff like that?
Well, you're going to get the same interest rate as anybody who's getting a loan right now.
Okay.
So this isn't a different loan product that you're doing. You're just getting your down payment, right? Are you asking about the interest rate on the loan that you're taking against your 401k?
Yeah.
Oh, okay. Sorry. I was confused there. Yeah. Like you're taking that down payment, then you're going to get long-term financing with, 4% rates.
Correct. Yeah. I assume that I'm locking in the mortgage rate, 4%, whatever. My loan rate is 6%, something like that.
Yeah. It'll be, I think mine's like 5 3/4.
Yeah.
But think about what you're doing. You're just paying yourself back. Right? Like, it's not like a cost to you. You're just changing money that was, qualified money in your retirement account and then becomes unqualified. And over time it gets qualified again. It goes back in your retirement account. So it's not like you're paying 6% or 5 3/4% interest to a bank.
Sure.
You are the bank.
Sure. Yeah. Like I'm thinking of it. So Leah's saying that non-recourse right now is like 6.75. Does that count? That's a non-recourse loan? Okay. So it's a different
Totally
thing.
Something different.
So, cause what I see it is like, all right, man, if I'm going to make 8% just inside the investment, and I can take money out that I'm going to pay 6% on, then I'm making 2% inside the investment. The cash flow can pay back that loan. And then I'm banking on that long-term appreciation as well with the leverage that's baked in as well.
It's even better than what you just said there.
Okay.
Right. You're thinking as if the 6%, let's just say, loan interest was being paid to somebody else. Like that's a cost. It's just a reshuffling of where the money is.
Okay.
It's still your money. So, if you're making 8% in your 401k right now, and then you took this loan out, and then you used that down payment and got long-term financing to go and buy a rental property, if you're in for a full market cycle, you see we can earn over 20% returns. Right? We saw on a few shows ago that Uday had a 26% return on investment after investing. So that's really the decision there, right? If you're in for a full market cycle, you could have the opportunity to earn 20% on that money versus 8% that you're earning in your 401k right now. So it's really not, subtracting the interest rate. The only cost to this, and this can change based on your 401k provider. Usually there's not many fees. I think it's like $100 to take out the loan.
Oh, okay.
And it's so simple. Like you can do it online. It's the simplest process for us with our company 401k. And it's very simple from what I hear for other companies as well. So if you're in a similar situation as Pablo and you're like, hey, listen, I'd like to buy rental properties in the next 1 year, 2 years, and you've got a 401k and you're like, well, I would absolutely encourage you to ask the question, can you initiate a loan against your own 401k and then potentially use that as a down payment? You can make a great decision today because like, as I mentioned, if interest rates go up a point and you make that decision 2 years later or a year later, your return on investment might 30%, 35% lower. You're going to percent return. Right now, you could buy it at an 8% return. So there you go.
I'm glad I asked that question. Great. That seems like a total no-brainer to me. Is it the same with IRAs? Do IRAs work the same way?
IRAs do not work the same way. So this is typically a company-sponsored 401k plan that you can take a loan against your 401k. Now, for IRAs and solo 401ks and other types of loans, you need a non-recourse loan product to pair it with. So there's a solution there. But if you had to compare getting non-recourse financing from your IRA or your solo 401k or taking a loan against your personal, like your company 401k plan, it is much better, much more advantageous to take the loan against your company 401k plan and then use that and pair that with conventional financing.
Okay. All right. That makes sense. Super. So I'm going to totally look into that immediately. GC, let's go into our usual conversation here, right? When, by the way, bring on the questions. If you are following along at home or you are listening on the podcast, go to jwbinventory.com. You can download the sheet. You can tinker with it. All right. So there is estimated conventional financing, total monthly cash flow, $131. There's estimated conventional financing, total ROI, 8.16%. I feel like we haven't gotten to this because we've had this like barrage of questions recently, but do us a favor and explain to us the total monthly cash flow, what it all represents, GC.
Yeah. So total monthly cash flow is the entrance to the dance when it comes to rental property investing, in my opinion, right? You want to make sure you invest in an asset, not a liability. And the simplest definition of an asset is, does it bring money to you every single month, or do you pay money each month because of it? If it brings money to you, that's an asset. If you are paying money on it, paying it to somebody else, then that's a liability. We want assets here. And so what we're looking for are investments that produce this positive monthly cash flow. And really, it doesn't matter if it's $50 a month in positive cash flow or $100 a month, $150 a month. Sure, we'd all like it to be higher. But the biggest thing here is that it's positive, right? It's break even or positive. Because if you look at your overall return on investment after holding on for 10 years or 20 years for this asset, and you see what percentage of that total return comes from your cash flow versus the other 5 profit centers, 90% of your returns plus are going to come from the other 4 profit centers. Cash flow is a small component of your overall return on investment. It's important because we want to mitigate risk and we want to invest in things that pay us every single month, but don't overinflate the importance of cash flow, right? Do I make a deal because I can get, $100 a month of cash flow versus $125 a month? I'm usually looking at a lot of other factors before I would make a decision on that one. So the main reason that you want positive cash flow is, again, for risk mitigation and scalability, because as your goals dictate, you're probably going to need more than 2, 3, 5 rental properties in your portfolio, right? If you want to get to $10,000 a month in passive income, you're going to need a substantial portfolio of rental properties, right? 10, 12 rental properties. So the fact that it's positive means that, you're not going in the hole. If you had to go in the hole $200 a month every time you bought a rental property, you're not going to be excited to put 12 of those in your rental property portfolio. There's a big risk with that. So total monthly cash flow gives you risk mitigation. It gives you scalability in this asset class, which most of you are going to need. It's like an entrance to the dance.
Entrance to the dance, because that's when I talk about quarterback arm strength. I'm not going to get into that today, but listen, to me, when I hear you talk about this and a conversation we just had of, do I take out a loan in my 401k or what do I do here? I just kind of see it as this monthly cash flow piece is just like, it's kind of other people's money once you put it in, right? Because if it's paying for itself while I'm getting my resident to pay down the mortgage, while I'm owning this long-term, while I'm benefiting long-term from home appreciation and the things that are happening in the macro economy, like it feels that to me is like the big unlock of just like this monthly cash flow paying for itself makes this thing not a headache, and it makes it feel like free money, even though it's not free money, but it just feels like money working for you, right? Like in a very tangible way that I had never experienced in my previous investing journey of everything else that I've done.
Absolutely.
Cool. Awesome. Before we're going to get into this total ROI, I guess you can explain it, but I think we can, you know what? Steve Lax is back with a good question here.
Love
it. We talked about cash flow. What are the other 4 factors that are not just cash flow? And I think this will take us into explaining this total ROI.
Yeah. So we talked about cash flow. There's 5 total profit centers. There's positive cash flow, like we talked about. There's tax savings, which are these incredible tax advantages that because you are a rental property investor, you have the ability to take advantage of that you don't get in other asset classes. There's principal pay down, which is this beautiful phenomenon where you hold on to this rental property for 10 to 20 years and you start to check your loan balance of what you owe that bank. And it might be 50% of what you originally originated your loan. You like that?
Mm-hmm.
Write that down. Of what your loan originated at. And it's because your resident paid it down for you, right? Other people call them tenants. They're residents, right? They're here for a long time and they're paying your mortgage off for you. That's principal pay down. And then you've got home price appreciation, which most people have no clue how to evaluate home price appreciation. We'll probably talk a little bit more about that.
Spoiler alert.
Yeah. But that is actually the largest contributor to your return on investment over a full market cycle. You hold on to this thing for 10 to 20 years and you look back and you're like, how did I earn this great return on investment? 60 to 70% of that return on investment, assuming you're conventionally financing it, will come from home price appreciation. So we can't ignore it. We just have to understand how to evaluate it, which I'm sure we'll get into. And then the 5th profit center is getting so much run right now. I love it. It's been just the, part of the equation that didn't get enough love for a long time. It's inflation hedging. Inflation is on the minds of everybody right now. If you want to beat inflation, buy and invest in a hard asset and then take out smart debt on that hard asset. That is the way to beat inflation.
All right. So Steve, following along at home, Lee Bishop put it here in the chat for you to understand it. The 5 profit centers are principal pay down, tax benefit, inflation hedging, home price appreciation, and cash flow, which we just talked about. All right. So those are the 5 profit centers. That's what's in the total ROI, but it says here 0% appreciation rate. I want to get into explaining that, but before that, Lee has a really good question here.
Mm-hmm.
And he puts, can you show the 1% increase in interest rate to show where it affects on this sheet, right? This is a great opportunity. If you haven't downloaded the sheet, get it, fiddle along at home with us, and we'll teach you how to do this thing, right? So where do I go to show this 30% decrease and a 1% increase?
Absolutely. Thanks so much for asking the question, brother. Let's go to the Analysis Conventional Finance tab right there at the bottom.
Okay, so 3rd tab on the right.
Yep. And we'll go up near the top there. It's in that financing assumptions.
Financing assumptions here. You go to H7 and you got the interest rate at 4% is the assumption.
And let's kick it over a little bit just so we can see the effect. There you go. Right.
Yeah. So we're looking at this H7 and then we're looking at this P6 over here. That's the total ROI for those of us following along at home.
Yep. And we'll change that bad boy from 4% to 5%.
It's a very bad boy. It's going to 5%. Here we go.
Boom.
And boom, it went from 8% total ROI to 5.45%. Exactly what you just said.
That's why I'm putting in front of you guys properties that can close quickly. Like there is such an advantage to closing quickly. Now, I'm just ecstatic that we have renovated properties where clients can take advantage of this right now. I mean, if you went back last year, right, if the Fed was doing all this activity in the middle of last year, that we did not have renovated homes. Right. It was 6 months out for putting something under contract until the time you can close. So I'm just ecstatic that there's that inventory right now. Our wonderful acquisitions team and our lending team has just done an incredible job of sourcing this inventory and clients can take advantage of it. But it's right there, right? The same, like a new construction property is going to have an 8% return that you're buying at right now. Call it somewhere between 7 and 9%. A renovated home has between a 7 and 9% estimated return, but that's all based on today's interest rate. And for this home And for any home that can close in the next 60 days, this is the interest rate you'll get. But if you buy a new construction home, this may not be your interest rate. In fact, it probably won't be your interest rate. There's no way of us knowing, right? But it's probably not going to close for 4 months or maybe 6 months. So you've got another 2 to 4 months of interest rate risk. And if it goes up, like we just showed, a full point, it's really, really damaging to your overall return on investment. I mean, there's no other way of saying it.
Makes a lot of sense, man. Makes a lot of sense. And again, that is the value of this sheet, right? Like you can obviously look at this property, but this sheet is totally, totally interactive. And you're looking at any other deals. You can mix and match the same numbers and really be able to like play with the numbers and see what happens, time value of money, all that good stuff that you can build into this. So go to jwbinventory.com and download one of these sheets so you can have it for all your deals. All right. Rick Henning's got a question. When you say no waiting, what is that time frame? I currently have 2 houses under contract. First house is a new build that went under contract in June with an expected completion date early September and is still not ready. Second house is a renovation with current tenant and we went under contract before Thanksgiving. We are getting close, but still not done. We were supposed to try and get closed in 2021 for tax benefits. So when you say quickly, what is that turnaround?
I love it. And just keep that there so I can see. I want to make sure I address all those questions. Rick, thank you so much for bringing some real life experience to the show and asking a really great question. And for those clients who have properties under contract, many of you are asking the same things, right? So Rick, you talked about just really kind of an understanding of what the time frame is. When you put a new construction home under contract today, your closing period is actually going to be between about 4 months to 6 months from the time you put it under contract. All right. So, and that time period has changed, right? If we went back last year when clients were putting properties under contract, you put it under contract, many times it was 8 or 9 months from the time that you put it under contract, right? The thing that affects that is, you know, the amount of builds that JWB can get through the process, the pipeline. And of course, the number of sales have been quite high this year, and we are pumping out new construction homes. So now we've actually been able to bring that timeline for new construction from contract to close down. I'm not going to sit here and say it's great because 4 to 6 months is not what I want, not what we want, but it's just the nature of things. And if you compare it to the overall real estate market right now, being able to put it under contract and close in 4 to 6 months is almost unheard of. Many times there's waiting list and then, you know, you got to wait 8, 9 months to actually close. So it's not meant to make you feel good about the process, but I just wanted to share with you, that's actually where we have been for the last year or so. So when you say that you put it under contract in June, and that it had an early completion or a completion date of September, but it's still not ready, that is real. That is really happening. You know, I don't know your specific property off the top of my head, but, you know, the last 3 to 4 months has thrown the new construction world for a tizzy when it comes to, I don't know if I've ever said that word on the show, by the way, tizzy.
Oh, cheesy.
Yeah, tizzy. It's thrown the new construction world for a tizzy. I don't know where that came from. You know, so the labor market, the supply market, the materials market is in tough shape. And it's because of the amount of demand that is happening for builds right now. Builds they're at levels that are prior to the highs that we experienced in like 2006, which was like the construction high, right? Before the great crash, right? The Great Recession. Right now, the number of building permits is more than that. Everybody who has land is trying to build houses, and, you know, supply chains are a mess right now. So it has gotten noticeably worse as far as the completion timeline from September till now. It really has. You may be saying, well, how did we drop it from 8 to 9 months to 4 to 6? It's because we had so many builds in the pipeline that we have just been getting through the process, but they still have slowdowns. So just wanted to recognize your concern. It's real. I'm sorry that it's taking that long. I try to share with people on the show as well, is that we're probably going to miss deadlines when it comes to new construction dates. And as much as I would like that to be in our control, there's macro factors that are going on here that the world really isn't prepared for. So it's a risk of putting properties under contract that are brand new construction. Now, if I take the leap to the renovation, which you also pointed out, you put under contract prior to November or prior to Thanksgiving, and we're hoping to get it closed. I wish we could have gotten it closed for you too. I don't know what happened there. The realistic timeline typically is somewhere around 60 days to close a loan. And that's assuming that the property was ready to go when you put it under contract, right? This house on Canaveral that we're looking at is ready to go. So I feel confident that somebody could put it under contract and close in 60 days. I'm not 100% sure of your property, but let's just say that it wasn't 100% ready for construction complete like construction wasn't complete, that may have kicked your expected timeline out a little bit farther. So not that surprising to me that if it was put under contract at the end of November, we couldn't close at the end of December. Typically I would plan for about days closing.
All right. I think that was all the entire question. I was double checking there. Yeah, I think it's good. Greg, I appreciate the transparency. Listen, I know for me, there was stuff that I had to go back and forth with the mortgage agent, right? Like, and then, I didn't experience these delays because I bought my stuff at the beginning of 2021, right? So it was right before it all kicked up. But it sounds like,
what did you buy as well?
I bought renovated properties
That were ready to go off the bat.
That's right. That were ready to go. They had a tenant in place. You had gotten it from somebody else and it was already there. And we haven't had to, we still have the original tenant in place that was there beforehand. Nice. So interesting. Okay, cool. Good to know. Lee Bishop asks on that question, Greg, does the extra holding cost on the new construction get pushed onto the client or buyer?
Lee, I just love your questions, brother. They are awesome. Lee is asking if the extra holding costs, like the taxes, the insurance, the interest cost that JWB bears during this process where it's under contract, does that go to the end buyer, the end client? The answer is no. JWB wants this to get closed as much as you do, because we've got hundreds and hundreds of these builds that are going on right now. And, it eats into profitability the longer it goes until we can close. So we are all feeling the pain. Absolutely. This does not get pushed to the end client. In fact, if you put it under contract, there is an agreed upon sales price, and that doesn't change no matter what. There's not escalators to the sales price, which is actually quite common in the space today, either a primary home or a rental property, investment property. Typically, you go under contract for new construction, person you're buying it from is going to put an escalator clause, and it might go up 1% a month or what have you. We do not have that at JWB. Very simple.
All right, on to the next one. Here we go. Michael Santorios. I have noticed the homeowners insurance costs on the older homes have increased substantially since 2019. Do you know what's causing the large increase in insurance costs on these older homes?
Michael, great to hear from you, buddy. One of our longtime clients, and Michael might be the biggest and best referrer of folks to JWB out of everybody. I mean, him and his family. So first of all, thank you so much for thinking of us. And you're right, homeowners insurance costs have gone up since 2019. They've gone up more for renovated homes than they have for new construction homes. The reason why is probably not something I'm best suited to speak on. We have an insurance team, and Michael, I'm sure you've met with the Ritchie Insurance Group. They could probably give you a better answer. I know enough to be dangerous, right? The insurance companies the big insurance companies are having more limitations on what they're going to cover. They are taking some losses and they are requiring a lot more. So they're reducing their coverage for renovated homes. And that's just the nature of things. Things are kind of up in the air when it comes to insurance companies. And they're really focusing on renovated homes because there's more variability and more risk for them there. New construction homes is not the same. I mean, new construction home rates are still low. You can still get a premium maybe for $500 a year or less. It's one of the ways we can still get positive cash flow for new construction homes. So it's just it's a state of, a little bit of flux right now in the insurance market. Is this the first time we've ever seen the insurance market be in a state of flux? No. Is this the last time that the insurance market will be in the state of flux? No, right? Been doing this for 16 years. You can imagine things that have really changed over those 16 years. So I'm not so surprised that at moments like this, we see cost increases on the insurance side. It's certainly not something that is scaring me to invest in rental properties long-term, because I think that there is too much riding on this to make sure that there is an insurance option that is affordable for people who want to own real estate. I think everybody could agree with that. And so things have gone up a little bit since 2019. If you want to get more detailed information, let my team put you in touch with the Ritchie Insurance Group and they give you better detailed information there.
There you go. Noah Randari in the chat. Great question. Noah, welcome to the show. Happy to get you participating. What class of properties have best home appreciation, Greg?
Oh, wow. No, I'm so glad you asked that question. The answer might surprise you. In fact, we did a show on the best neighborhoods to invest in the state of Florida, ranked by home price appreciation over the last year and over the last 10 years. Zillow produced this data out there. And wouldn't you know, Noah, that 9 out of the 21 fastest growing, meaning highest appreciation neighborhoods, the number one fastest growing, meaning highest appreciation market in all the state of Florida last year was a C neighborhood. Is one of JWB's core neighborhoods in our core neighborhood, which are all below middle income. And so I think what you're seeing here is that affordability really matters, right? We got to look beyond just the amenities and, how housing looks and what our preconceived perceptions are of where there's value. For something that is affordable right now, there's a tremendous amount of value. And that's really what this data has been showing. In fact, affordable housing is probably going to be even more important over the next decade than it was over the past decade, because we're seeing how much home prices have increased. So yeah, the C neighborhoods have actually increased the most. That's actual data in the state of Florida over the last year. We started to invest in C neighborhoods long before this data was available. We've been doing it for 16 years because it creates a great opportunity for risk mitigation and growth, right? Risk mitigation is that positive cash flow. That's why we love the C neighborhoods. And then, of course, there is an opportunity for growth. And last year we saw it like we, quite frankly, I've never seen appreciation like that, like we saw last year. And it happened in the C neighborhoods.
All right, there you go. Great question, Noah. Love it. Steve Lax is back with another question. Do you have any particular lenders that we can contact directly?
Well, easy one for that one, Steve. Absolutely. We have lenders that we can put you in touch with. There's not just any lenders out there. These have been vetted by our team. They have closed dozens and sometimes hundreds of loans for our clients. So Steve, reach out to my team, start those conversations. Happy to introduce you to a member of our network, a lender that would be able to help you. And then hopefully we can help you build that rental property portfolio.
Steve asks, can you discuss the pros and cons of interest-only mortgages and suggest some lenders that provide such loans?
So great question. We haven't talked about interest-only loans on the show, I think. So thanks so much, Steve, for bringing it up here. Interest-only loans can be an opportunity for some folks. I have used them to build my rental property portfolio, but I'm very specific about how I do it, right? So I'll tell you how I do it and how you probably shouldn't do it. An interest-only loan is a loan where you can basically only pay the interest back. So normally in a loan, it's amortized and you have to pay principal and interest back. Well, there are loan products out there where you can choose to only pay the interest, which reduces your cost each month, right? That would increase your cash flow because your loan expense is lower because you're only paying the interest. Right? So that's one of the pros, right? A lower monthly expense during that time that you have that interest only loan, right? Another pro to think of, and then I'll get to the cons, is that usually for these types of products, these interest only products, they are adjustable rates. That's not a pro, but that's just what it is. And usually with an adjustable rate mortgage, they give you an introductory period where your interest rate is actually lower. It's lower than what it would be if it was a principal plus interest loan. So generally speaking, you actually could get a really low interest rate. Of course, with that, it comes that it's an adjustable rate mortgage, which probably not a good thing. But so there's some pros there. And then if I'm going really technical, right, what you're doing is you're making the choice to keep the cash flow that otherwise would go to pay down your mortgage. And it would be like if your interest rate is 4%, you're basically, you have the option of whether to use that cash flow and pay down 4%. And earn 4% on that money. We as investors, we know that we can earn a higher return on investment than 4%. So if I was being really technical here and I was only cared about return on investment, you can make an argument that, this could produce a higher return on investment for you. I'm just throwing that out there. There's a lot of cons with interest rate only mortgages, and we don't see a lot of them. In fact, I asked my sales team, have we ever had an interest only client, an interest only mortgage? Nobody could think of one. So it's not something that works well for long-term interest rates, or long-term mortgage products. It works, and it can work well for short-term lending, right? So here, let's get into the cons, right? If you take out an interest-only loan, right, you're not paying principal down. So one of your profit centers is not happening, right? Your principal pay down is not happening. You're getting the cash in your bank account. So that's good, but you're not reducing your loan balance, right? How could that, be a downside for you? Well, if you're looking to go and refinance a property in 3 years or 5 years, and you take out an interest-only loan, well, your loan balance is not going down. So it would be harder for you to refinance. You would have to bank on more appreciation, or else you'd have to come out of pocket, cash to do that. If the market crashed, right? well, you would have a higher loan balance than otherwise if you paid principal and interest down. So it's a riskier type of product. For me, so much value for what we try to create for our clients is in this passive income, set it and forget it type of model. That's really what we're trying to create, this experience for clients. So getting an interest only loan is not set it and forget it. It is kind of trying to be getting the absolute highest return on your investment and giving yourself some flexibility. But, it's more work to manage it, in my opinion, and it can create more risk. So as I mentioned, we don't have any, maybe I could find a lender for you. I would encourage you to reach out to my team if you really want to start to explore it. Maybe your specific situation might be one that it would work, but I probably doubt it. But my team would be happy to try to introduce you to somebody who might be able to help you. Let me tell you about one time that it does work. Like as I mentioned, that I've used interest-only products before. There's an interest-only product that we've talked a lot about on the show. It goes by a different name, but we've talked about how I think it's a great use of capital right now. You know what I'm talking about?
Go on. Is it private lending?
No. I'd be shocked if you got this. This would be awesome.
Then stop, man. Just let me know what it is.
I was just
flapping out here in the wind.
A HELOC, a home equity line of credit, is an interest-only product. So why do I like a home equity line of credit? Well, I don't advise people to go out there, get a home equity line of credit, and then keep that as your long-term debt on your rental property. I say, hey, listen, if you're looking to get capital for a down payment and you've got this equity in your home, and you want to borrow it short term to be able to acquire the property, a HELOC might work for you. So that's the way that I've used it in the past. It's very short-term debt. You get access to capital, but you have to have a long-term plan, either to pay that debt off quickly before the loan adjusts, or refinance that property, or do whatever you need to do. You have to take that next step of understanding how you're going to get out of that short-term interest-only loan, because it does increase your risk profile.
Very complete answer to a great question. Thank you, Greg.
Not exactly rapid fire though, huh?
Drew, well, I didn't prompt you for rapid fire, so you're good. Drew Barnhill knew it already. He said HELOC. He also summed it up with riskier and more expensive in the long run, and that's why they're only good for short term. So that's the rapid fire.
That's
response.
it. Yeah, that was it. True.
No, but
You're right.
Steve came for the value, right? Rapid fire real quick. Chris Gonzaga asks, are maintenance charges of property before closing normally the buyer's responsibility?
No cost of the property prior to you owning it will be your responsibility.
That's rapid fire right there. You did it. Okay. What we didn't do today is show you the effect of home price appreciation on the spreadsheet. We'll do that again next Thursday so we can continue to educate you. We've done that a lot in past calls. You can go to past POTWs. We do it a lot, but that's a really, really interesting calculation. If you download it at home, put in 4.3% home price appreciation, or put different appreciation assumptions based on how long you're going to think you'll hold it. And you're going to see that the interest rates goes way up. This was an awesome show. We're closing it in under the hour. Next week is a special week because GC is coming out with a little thought leadership for you people. He's got a new concept he's unveiling that he's been working hard in the lab. You want to tell us about it, GC?
Yeah, I've been spending a lot of time trying to think about our vision for our show and how we can best equip our community here to get the most value out of the show. My good buddy Pablo has taken the reins of booking our talent for the show and the guests that are going to be on our show for our Tuesday show. And I'm so excited about the talent that he's bringing to all of you guys. It's going to be talent far beyond just rental property investing. And I just think that's incredible because we're kind of coming into our zone of what the Not Your Average Investor show really is. We're going to be talking with folks about investing in crypto and note investing and foreign properties coming up. These are going to be different things than you're just hearing about with JWB. And that's what excites me. I hope it's what excites you. So the reality though, is that we have more options to invest. We have more access to information, but people are more scared and more unaware of how to make the decision of where to put their money in today's day and age. It really doesn't make sense, right? You would think if you had more access to information, you could probably make better and be more confident in your decisions. I think what's really lacking is a way to compare apples to apples between the different asset classes. And so I spent some time thinking about myself and thinking about what really matters to me as an investor. And I put together this investment scorecard and I wanted to share it with all of you. And what I see this being is basically the foundation for, when we bring on a new show guest and we're talking about their asset class, we're all going to have open eyes and open ears and really try to learn about it. And then I'm going to ask them to kind of like speak to me in terms of these 6 investment criteria. And I think what it's going to do is allow all of us to kind of analyze and say, well, this asset might be great for you, Drew, right? This asset might be great for you, Noah, because you like these 2 or 3 criteria, whereas this asset class might not be great for you. So I put some time and energy into it and just wanted to share it with the community. And I think it's going to be something that hopefully you guys see a lot of value in.
It's the scorecard, right? It is the Rosetta Stone of how to judge, how to translate between the language of the different investment classes, right? Like as we launched the show, we knew we had to spend a lot of time educating our community on rental property investing. We feel that the knowledge is really, really high right now. And as we expand the tent, right? As we bring in people that, quite frankly, we don't know that much about their asset class. We're going to be learning alongside with you, right? Like investing real estate in the metaverse, your boy GC knows nothing about it. Neither do I. Note investing, he knows a little bit. I know nothing, right? We're bringing these different things. We're bringing all these different asset classes. So if we can standardize a way to look at it, that's what I challenged him with. I'm really, really pumped with what you came up with. We're going to break down those 6 different criterias and how to judge the different things. And then we're going to double tap into the actual rental property investing, how that performs, so that going forward, as we start expanding the umbrella, you have this template to analyze, man. I'm super pumped for it.
It's going to be awesome.
As we like to say, if you wanted to find out about rental property investing, you wanted to find about property management for rental property investors, or you want to find out about the Jacksonville market, you're in the right place right now. We're going to be talking about other asset classes in the future as well. But if you want some help with that stuff, go to chatwithjwb.com, book an appointment. They'll show up. That's what happens, right? And you're going to have a really, really great conversation. This has been an amazing property of the week. The chat is blown up with love. We love you right back. Thank you so much. We could not have this show if you didn't take an hour out of your day to show up for an hour and gift that to us. So we want to give back as much as possible. And the fact that you're showing up means that, that it's valuable to you. That's what we take seriously. GC, thanks for being a part of this. Take us away.
Yeah, man. I just want to say thank you to you all. You guys make this special. Kind of kick myself every single day we get to do this show, thinking about, where it started and what it's become. And it's because of all of you guys. So big heartfelt thank you. And if you have friends or family that we would like to join this amazing community and want to, send an invitation for them to be a part here in Zoom, we would love to include them as well. You can just send people to nyais.com, nyais.com for Not Your Average Investor Show. Have them join the party. It's a lot of fun. You guys make it so much fun. So love to keep bringing the right people to the community.
If your Tuesday afternoons and Thursday afternoons are feeling average and you don't want to be average, join us on the Not Your Average Investor Show.